There are old traders and there are really bold traders, but there's very few old, really bold traders. Discretion is always the better part of value.
Jim, you've been in the futures and options trading world for over 30 years. You've been a broker, you've been a trader, you've appeared on some of the most widely watched financial news networks, hundreds if not thousands of times. How'd you get into this? Tell us a little bit about your start.
When you put it like that, it has been a long and wild ride, 37 years ago. So the year was 1987 when I got out of school, University of Illinois, with a major in economics. And I knew a couple things. I knew I loved my major. I loved economics. But there they don't teach you a ton about the futures industry. At least they didn't me. And as I got out, I was looking for a job, and I was only casually aware of what went on in the futures pits. So I asked around a few people. I knew one guy whose father had worked there and had great things to say about it. And then I had a friend who was a few years older than me in school, who I knew worked for Goldman Sachs on the trading floor. So I called him to see if there was a way to get involved. And he was like, oh, this is pretty fortuitous. Goldman's just hiring on new people because we're opening a gold pit at the CME in conjunction with the currency quadrant. So he said, would you like to interview for it? So I did, and I apparently they liked me and they hired me, and it's pointed me in a lot of wild directions since.
So now most people that I'd talk to that started on the floor, I'd say, tell me about your transition off the floor, but it turns out you're actually still on the floor. Mm-hmm. But around probably mid-career, I'd say, the floor really, or the market really transitioned from the floor to the screen. So tell me a little bit about how that evolution was for you and kind of how it impacted what you were doing.
So it's really amazing how it happened, because at first it was just a thought, moving things to the screen. It took a couple years for that to gather momentum. But once it did, most of the products from the trading floor they didn't lend themselves to being traded on a trading floor anymore. Now, a couple of them did survive. The one that was my primary focus was the 3-month interest rates. It used to be called Eurodollars, now it's called SOFR. Sure. And the reason which is fascinating to me, is that it is such a complicated product that some of these big users around the world weren't that confident of executing themselves. So we, in the chain of execution, provided more of a layer of safety. So it's come back and it's actually thriving. It's a ton of business. Now, my own personal trading, I trade that product myself too, but all the rest of my trading is screen-based. There's nothing that I trade there's very little that's floor traded anymore. So all the stuff that I did before in pits, which was commodities, S&P indexes, metals. Sure. Now my trading in those is all screen-based.
Sure, because as you alluded to, that is literally the last floor-based market that we have, that short-term interest rate market. Maybe more so than any other profession. There's ups and downs and highs and lows. So tell us about a time, a day, a trade where you said, man, am I lucky to be in this business? And if it's not too painful, tell us about a day, a time, an event, a trade where you said, I'm done.
It could be the same day, but I'll start with the most amazing day where I felt like I was in the epicenter of the universe, the financial universe. I started in July of 1987, July 7th. By September of that year, I had barely learned what we were doing. I worked for Goldman. I worked in the foreign currencies.
Anyone our age knows what's coming. Let's hear the story.
Was it September or October? Whatever it was. Right? It was October. It was October when all of a sudden S&P cratered like 40% in a single day. I might be exaggerating that a little bit, but it was a massive stock market, bear market correction. And it was on headline everywhere. And I remember the Goldman staff that I worked in the currencies, we flipped over to the S&Ps to assist because they were up to their eyeballs in trades, and it was nuts. And I remember just feeling like the whole world is watching these markets right now. And it felt really cool to be at the center of it. So that was it, and I was going to put that as my worst day too. There's a lot of stuff. No, but there's been times along the way. In the great financial recession in 2007, 2008, it was so crazy. And again, now we're talking about I'm at a much different age by that point in time.
Sure.
I'm older. I'm not as naive about what's going on, and it really weighed on me quite a bit.
Yeah.
And there were times where I just wanted to just not be part of financial markets just because everything seemed so depressing. Which, by the way, it was not a bad time to make money. That wasn't it at all.
Right.
There was volatility in the markets, and there was money to be made, but it was just so incredibly stressful to see us making money and capitalizing on this volatility where the rest the rest of the world was going to suffer so mightily. So I didn't love that, and would have liked to have been on a beach somewhere playing my guitar, which means I have to learn how to play the guitar first. But that's what I would
Right. No, it
about.
makes perfect sense. And I missed the '87 crash. Was working at one of the proprietary trading firms during the financial crisis that you're talking about, and it was kind of the first time where, to me anyway, in my career, that we said there's nothing that can't happen anymore, and that's what was so kind of scary about it.
Crazy. And watching that movie, The Big Short, and I try to watch it every year just to remind myself that there can be these stresses built up in markets that go on for decades, and all of a sudden they can flip. So it helps me kind of get my head around the notion that keep nimble, keep your eyes up, and discretion being the better part of valor.
So switching gears just a little bit, obviously you've come up on the institutional side. You're still working on the institutional side of the business, but your personal trading, as far as I know, you're not using nanosecond type speed advantages. You're not using automated quoting algorithms and things like that. In my mind, you're more of what we might call a retail trader. Is that a fair assessment of
absolutely.
what you're doing?
Yeah, I've for 25 years have traded my own account on the retail level alongside my brokering for institutional clients and doing analysis for them. And absolutely, I trade every day, and I love trading.
So what do? You're using charts, you're using fundamentals. I mean, we've talked about both in the past when we've worked together, but how are you deciding what to trade and when to trade and things like that?
I think for anything that's inside a couple weeks hold time, technical analysis is more important than fundamental analysis. Fundamental analysis is great for portfolio construction and investment in long term, which I do a lot of that as well. But I would say that I am 70% technical analysis, 30% fundamental. And then I always joke that the 30% fundamental is just kind of to be able to talk myself into or out of the technical, you know what I mean, just to bolster it.
Great. Yeah. I think one of the things CME's done a good job at over the last several years at least is providing the retail trading market with products that are what I might call right size. So if you go back to 2019, we launched the micro equity indexes. We've since launched some even smaller products than that. The other thing that we've done is bolstered our education for retail investors and retail traders. So what tools do you take advantage of that may not have existed 20 years ago, and what are some of the products that you like to trade?
So the micros, I think, are fabulous, not just for newcomers coming in, but for people who are experienced as well. It's not every trade that you have such strong conviction that you want to load the boat, as we say. There's so many different trades where you're like, okay, this is a decent setup, let's see if this can work. And it's so much easier to put this amount of capital to work than it is to put that amount of capital to work. So I love the micro products. You do a couple of those, and also it's a scalability. If you buy 5 of the micros, if you have 1 of the big contract on, or 2 of the big contracts on, if you're getting out at a certain point, you're getting out either all or half.
Sure.
When you have 10 of the micros on, you can pinpoint it
a little bit more flexible,
and you can test different strategies. Because probably over the last 30 years, I've used probably 7-8 different types of technical analysis because they have a shelf life.
Sure.
One of them will work for a while, and then it will start to work less, and then it'll start heading towards not working at all, and you switch to see what does work. That's one thing that a lot of people forget about different technical strategies is they don't go on forever.
Sure.
So once the juice is squeezed, you move on.
And that's not dissimilar to some institutional strategies that, kind of all of this stuff has a shelf life. The market changes, the dynamics change. If you're talking about the E-mini NASDAQ future, that's a $450,000 contract with one futures contract, whereas the micro is 1/10 of that, or $45,000.
Yeah, so. And it's funny is that, like, when the E-mini was launched, it was supposed to be the small one. Well, the NASDAQ itself has quadrupled in value since then, probably even more. So that contract has graduated and grown into a big contract. Now the micros come in and it's perfect.
Sure. And like I mentioned, I think CME's done a good job of providing the marketplace with software tools, whether it's options analytics and things like that. One of the nice things for retail traders now is that there is so much software available for a fraction of what it might have cost 10, 20 years ago.
And I keep looking at new ones because there will come a day, I'm 60 years old, where I will trade less, trade from my home, not have to be in contact with clients, and might not be able to justify the big money for the ticket. Yeah.
Sure. Yeah. One of the things I hear a lot, I go to a lot of industry events through brokers and just kind of through the industry, and I hear retail traders say to me, I don't feel comfortable. I can't compete with the big boys, with the commercial firms, or with the banks, or with the high frequency firms. And I spent some time on the sort of market making side, so I can honestly say to them, there's not a market maker out there that's looking to pick off retail. But the fact is that you're still in the institutional world and are comfortable being a retail trader as well. So I think that speaks to the fact that when you know the business, you realize that it's not a us versus them thing.
Right. It's not an us versus them thing. And the notion of it is kind of ridiculous because, there's so many different retail traders out there. Do these people really, are they making the argument that the algorithms are out to get all of them? I mean, that makes no sense because they have different opinions, different assets they're trading. So I don't think that's the case. What I will say to people is that oftentimes people look at the same technical analysis. And this kind of circles back to what we said before, of that it doesn't always work forever. And if everybody's starting looking at a sim one, it becomes more popular, then everybody seems to know where the stops are, where the takes profits are, because they're looking at the same
Sure.
book. So I think sometimes it seems like people are against you, and what that means is your strategy is probably a little bit stale.
Sure. It feels like it, but in reality, if you really know the market structure, the market dynamics, it's really not what's
And
what's
also,
going on.
and let's say people think that's happening to them on an hour-to-hour, minute-to-minute, day trader type scenario, then back off. Raise your parameters. Make your hold time a week. Make your hold time 2 weeks. I've done that several times in my career. See if that works.
Last thing, one piece of advice you'd offer to someone that's just getting into the trading space.
Okay, the first half of my career, emotion, temper benefited you. You were screaming in the pit, you were wrestling to get a trade. So all of a sudden, everything goes now to the screen. And even in my job now, where we're still in the pit with the one product, but then my trading myself, it requires you to suspend all those emotions. And that's why I would tell someone is that if you are going to take a trade, if you're going to get in a trade, you must clearly in your head decide what the take profit is, what the stop out is, or hedge it with options, and then just put it on and don't let your emotions make you overcook it. And again, I speak firsthand on this, is that I know that my emotions can sometimes get to me. So I like to use pretty strict hedges. I remember I had a partner in trading a couple of years ago, and one time I said, I think we're hedged pretty good on this. He goes, yeah, I think either way the market goes, we're going to lose a little bit of money. And I was like, oh yeah, you're right. We better go back to the drawing board and figure out how to make money.
Right. I mean, in a lot of ways, a good trader is more a good risk manager. That's almost a more descriptive way to say it.
There's no question about it. There's this saying is that there are old traders and there are really bold traders, but there's very few old, really bold traders. Discretion is always the better part of value.